All right, let's get right into it. The silver market is flashing some very unusual signals right now. We're talking about a huge physical withdrawal from the vaults, and at the same time, a sudden policy change from the exchange. And all of this is happening just hours before a major economic report drops. So in this analysis, we're going to dissect the data, piece by piece, and try to understand what's really going on. Okay, so here's the puzzle. 6 million ounces of silver, just gone from the Comex vaults. At almost the exact same time, the CME Group, the exchange operator, suddenly cuts margin requirements. Now the big question, the one every single trading desk is asking, is why now? Why make these moves right before the most critical jobs report we've had all year? Right, so these aren't just random events. You have to see them as three distinct signals, all happening at once. There's what the physical metal is telling us, there's what the exchange's policy is telling us, and then you have this massive macroeconomic catalyst looming. You really have to understand all three to get a clear picture. So, this is our game plan. We'll start with the physical withdrawal. Then, we'll dig into what that margin change really means. And finally, we'll map out the scenarios around the big catalyst, the non-farm payrolls report. Okay, let's jump into our first piece of evidence. What's happening in the physical market? Because what we're seeing here, well, the actions are telling a completely different story than what you might be hearing from the speculators. Now, look at these numbers. The sheer scale of this inventory drain is what's so striking. We're talking about registered silver here. That's the metal that's actually available and ready for delivery, and it has absolutely cratered down to just 86.1 million ounces. That's a 31% drop. And let's be crystal clear, this isn't some accounting trick where the silver was just reclassified. No, that 6 million ounces left the building. It's out of the Comex system completely. And that really gets to the heart of what's driving this. This isn't about speculation. It's about necessity. The players pulling this kind of volume out of the vaults, they're doing it because they actually need the physical silver. Think industrial use, fulfilling contracts, maybe even building up strategic reserves. This is what we call structural demand. It doesn't really care about the day-to-day price swings. So what we're witnessing here is this incredible split, this huge divergence between the paper market and the physical market. On one side, you have the paper market, futures contracts, where speculative interest has just collapsed by 77%. But then you look at the physical side, wow, demand is so strong that on the very first day for delivery notices, buyers laid claim to over 60% of the entire available stock. The two could not be telling more different stories. And here's the real kicker. The reason why this physical demand is such a big deal for silver, the supply is what we call inelastic. See, about 70 to 80% of all new silver isn't mined on its own. It's just a byproduct of mining for other things, like copper or zinc. So you can't just decide to produce more silver tomorrow because the price went up. You can't just turn on a tap. Getting more supply online takes years, not weeks or months. All right, moving on to our second piece of evidence. This one comes directly from the exchange itself, the CME. And believe me, their decision to cut margins right now, well, that's a signal that every institutional player is paying very close attention to. To really get why this is so important, you just have to look back a little bit. Remember the last big run-up in silver? What did the exchange do? They hiked margins again and again. They made it more expensive to hold positions, which forced a ton of selling and ultimately killed the rally. But today they're doing the complete opposite. They're cutting margins, making it cheaper to be in the market. So, what's the signal here? From an institutional standpoint, the message is pretty clear. When the exchange cuts margins, they're basically saying, we think the risk of a disorderly market at this price is low. We're comfortable here. It lowers the cost of capital to hold a long position, and that's basically a green light for money that's been waiting to get into the market. Okay, we're about to tie all of this together, the physical demand, the exchange policy, and connect it to that final macro trigger. By the way, if you're finding this analysis valuable, please take a moment to like, share, and subscribe to our channel. That way you won't miss any of our future breakdowns. And that brings us to the final piece of the puzzle, the catalyst. All this potential energy has been building up in the market, and the non-farm payrolls report, well, that could be the spark that sets it all off. So let's game this out. There are really three main scenarios. Scenario 1, a weak jobs number, let's say under 60,000. The market's going to immediately think the Fed will have to cut rates. That means a weaker dollar, lower yields, which is typically very bullish for silver. Scenario 2, a really strong number, say over 100,000, that reinforces the whole higher for longer narrative from the Fed, which means a stronger dollar and a headwind for silver. And then there's the middle ground, right around consensus. In that case, the macro picture is kind of a wash, and the market probably defaults to focusing on those powerful physical market forces we just talked about. Okay, so we've looked at the physical market, the exchange policy, and the macro catalyst. Let's put it all together now and talk about the main thesis and, just as importantly, the key risks. So the bull case is pretty straightforward. You've got this incredible physical demand hitting a supply that just can't respond quickly, and now the exchange has made it cheaper to get in on the long side. But there is a counterargument, and it's that the margin cut isn't a bullish signal at all. Instead, it's the CME signaling to the market, don't worry, we've got this delivery situation completely under control. So, boiling it all down, there are 3 core risks that we absolutely have to monitor. First is exchange intervention. They can always change the rules or even force cash settlements if things get wild. Second is the macro risk. A surprisingly strong jobs report could easily strengthen the dollar and put a lid on any rally. And third is the risk that this disconnect just continues, that the paper price stubbornly refuses to reflect the extreme tightness we're seeing in the physical market. And that leaves us with the ultimate question. For what feels like the first time in a long while, the signals from the physical world and the signals from the exchange's policy seem to be pointing in the same direction. So is this jobs report the final domino? Is it the one event that's going to finally unleash the next big move for silver? I guess we're all about to find out.